special guest this morning into our studio, Nimesh Chandan, Chief Investment Officer of Bajaj Finserv AMC, joining in. Nimesh, very good morning to you. You know, the two buzzwords right now, AI and IT. And I'm wondering how you're looking at it, or are you sticking to the straight and narrow, or, you know, as a regular guest on our show, Parag Thakkar says, the boring stocks?
Actually, if you take any technology shift, any major technology shift, it creates opportunities for some and it creates like some problems or challenges for some. I think overall, India will actually benefit from AI. In terms of IT, there will be some areas where the efforts, let's say, will be reduced. In some areas, there'll be new projects that will be coming in. Now, if I take the impact on stock prices and say divide it into three parts, technology, fundamentals, and behavioral factors. Technology, it'll create some opportunities, but people will wait to see exactly what AI can deliver and take a judgment on that. So there's some uncertainty there. On fundamentals, most of these large, at least IT companies, were growing between 4 and 8% revenue growth. Even if there is a slight decline there, then people start questioning the valuations there. So the growth anyway was a little slow, and now there are questions on that. The third part is typically how crowds react when something like this happens. When there's uncertainty, people factor in their worries in the valuation, which means the valuations fall. So even if you are seeing from here on earnings not really changing or earnings downgrades not as much, we'll definitely see some valuation pressure. And we've been at Bajaj Finserv AMC, we've been underweight on IT for some time. So with these reasons in mind, that
so
there
even
could
the
be some
current
valuation
valuations, just to get that clear, even the current valuations, which some have described as mouth-watering, are not looking exciting to you right now, of some really stellar, top-notch blue-chip IT companies.
When I look at their dividend yields and cash flow, they look attractive. But when I look at growth, which is also an important component of the valuation part, it's not so mouth-watering.
Okay, what levels in terms of valuations, if you have to give a broad range for the large cap IT companies, do they become attractive? Because we have been having this conversation over the last 2 to 3 days, and a couple of analysts are not happy with the way price to earnings to growth ratio, the PEG ratio is concerned for IT companies. Anything that you would want to add on that front?
I think you've hit the nail on the head that it's a PEG ratio that most people are worried about, that there are other sectors which are growing at a faster clip and available at similar or probably slightly premium valuations, but because of the growth it justifies. Higher growth companies by 2008, 2029, 2028, 29 valuations, they will become attractive then compared to IT companies then. So I think the PEG is the issue. Now whether there can be a bottom in these stocks, yeah, probably they may not decline much from here. Now, we are bullish on the market. So I would want a portfolio which participates in the bull market. So till the time these worries sustain on IT sector, they may not give me that kind of gain. So I find other sectors, or my team finds other sectors more attractive to be in.
Okay, so categorically bullish on markets, but not on IT.
Absolutely.
Which is one of the heavyweights that contributes, right? The other sector that contributes to that kind of bullishness, when you have to just look at the large cap universe, is your financials. Where are you in terms of financials right now? And if you have to get that divide between the PSUs and the private banking space?
So we are bullish on the economic cycle. We are seeing upgrades in GDP growth and economic growth. We are bullish on the profit cycle. We are seeing corporate profits being revised upwards. We are bullish on the interest rates or the credit cycle. Interest rates have come down, creditors picking up. When these three cycles do well, markets typically do well once there is a change in sentiment. And I think the sentiment has been under pressure. Now, whenever these three cycles are doing well, you go bullish on cyclicals like financials, industrials, and materials. And these are the sectors we are bullish on. So financials being part of that, we are quite bullish. We have tilted the portfolios more towards private banks. Both large as well as mid-cap private banks, which are now having access to large capital, and reduced a little bit on NBFCs and PSU banks.
You know, I'm just wondering, when you talk about corporate results as one of the three reasons, there seems to be a bit of a mixed view on that as well. Are corporate results actually looking as good as they are optically? Is there some of base case which is playing through? Has that tough corner been turned? Would you say, in large part, corporate results have been better than you expected?
So we look at slightly longer term rather than just one quarter. This quarter has been satisfactory, I would say. I'm not saying there's too much excitement, or I don't think there have been many misses also.
If I look at the last 4 quarters, then it looks more depressed, doesn't it?
So let's look at the trend. So in, say, FY25, Nifty earnings grew by about 6.5%. FY26, we are likely to grow at double digits, somewhere high single or low double digit, 9 to 10%. Next year, the projections are between 14 and 17%, depending on whose estimates you are taking. Now, I can see clear acceleration there. And all the changes that have come in the economy, in the fiscal policy, in the monetary policy in the last year, will start showing the numbers in businesses in the coming year. Consumption has triggers, capex has triggers, and government spending also continues. So I'm quite bullish in terms of cyclical.
Will this be an earnings-led rally from here on? And if that is the scenario, are you seeing any revision or upgrade in terms of the valuations? Is there a re-rating possibility in terms of Nifty?
It is always an earnings-driven rally. So if you look at the longer-term Nifty movement, it coincides very well with the earnings growth of Nifty. So whenever there is an acceleration, you actually see Nifty performing better. And compared to the time correction that we've gone through in the last 1.5 years, now the valuations are also attractive.
Okay.
What about the broader markets? Do they fit in with this kind of a move? Because you've seen that cycle turn there as well. And the earnings growth, I was just looking at the small cap, I think what is 35-40% in terms of profitability. Your mid caps is somewhere in that 15-18%. Large caps is still lower than that. Is it going to be the broader markets?
So in December 24, small cap earnings were not doing so well, but valuations were very high and people were so bullish on small caps. Now, 1 year down the line, small caps earnings are good, but people are not so excited about small caps. I'm not saying it's because it's a very broad category and you cannot time it that you have to look at, say, a particular time to buy small caps or sell small caps. But within overall, if the small caps are doing well in terms of earnings, there are many pockets that you can pick where you get good growth to valuation ratio and you can pick them. So this is a good time to selectively pick up small caps.
Yeah, but obviously you can't give us any specific names, and I understand that completely. But thank you so much for coming in and speaking with us today, Nimesh. Absolute pleasure to have you in our studios.
Pleasure being here.